Taxes are a major outflow that significantly drains your wealth without you realizing it. I know, just like me, you are probably passionate about building wealth, but high taxes keep getting in the way. And I can also understand why this might appear to be an insurmountable challenge for you. That's why I'm doing this video where I'm going to be talking about the top 10 guarantee strategies to adopt to save the most taxes for you and to retain the most from whatever you earn. And by the way, you have to promise me that you're going to channel all the tax savings and returns you'll be getting from applying these strategies to your investments only. Just don't let those funds sit in your bank account. As always, I've already included all the chapters I'll be talking about in this video, including their respective timestamps for easy navigation. So my number one strategy is what I call the setting up of a tax-sheltered investment account. So specifically, you can actually contribute to your TFSA, FHSA, RESP, defined contribution plan, and all the gains you make in those accounts would not be subjected to tax. In addition to that, you can actually contribute to your RRSP account up to 60 days after the year end, and whatever amount you contribute, you can get as much as 20 to 30% of it as tax returns. So the use of tax sheltered accounts will significantly save taxes for you at the moment and down the line. So the second strategy you need to adopt is what I call making donations to charity. So whenever you make donations to charity, you can get as much as 33% of your donations in tax returns. Now, you don't necessarily have to donate only in form of cash. You can donate in form of property, assets, stocks, and other cash and kind sources. However, if you receive anything in exchange for those donations, maybe a ticket to a show or an event, the value of that ticket or whatever you received must be deducted from that donation, and whatever is left will be your actual donation, which you would include in your tax filing for the year. The third strategy is what I call designating your home as a primary or principal residence. I'm sure you already know that whenever you sell your home or any major assets, whatever gain you make on it, which is the capital gain, will be subjected to tax, which is the capital gains tax. However, if you live in that home and designate it as your principal residence, you can actually bypass the capital gains tax, and of course it will be overlooked, which means you don't get to pay any capital gains tax as a result of this designation. Number 4 is the allowable deductions. Now, CRA allows you to deduct certain expenses, but I'll be talking about the least common ones, which I've seen a lot of people neglect. So the first deduction I'll be talking about is what I call medical expenses. So if during the year you incurred costs on medical expenses on your dependents, like your children, your parents, your grandparents, you can be able to claim tax deductions on those expenditures. So you can actually claim all these tax deductions up to a certain limit. However, this still helps you to save taxes overall. But remember, very importantly, whatever you're trying to claim must not have been reimbursed or refunded maybe by your company or by any other organization or association. It must not have been refunded or reimbursed. The second neglected deduction is what I call the moving costs. Now, based on my experience, I've noted a number of people that actually incur moving costs but fail to recognize that when they file their taxes. So if you have had to relocate for work purposes within Canada and the location is more than 40 kilometers away from your previous home, then you can claim this deduction. So your moving cost deduction will include eligible moving expenses such as travel costs, address change fees, title transfers, and many more costs associated with your traveling. So the third deduction that is well neglected is when you write off your capital losses. So whenever you sell your home or your assets at a major loss and you incur a capital loss, you're allowed to deduct that amount in your tax returns. However, you need to do it strategically so that it aligns with moments when you're expecting capital gains from other areas of your finances. Another deduction is what I call the union or professional dues or licensing exam fees. If you have had to pay a union or professional organizational dues, licensing exam fees, insurance premiums for your profession, and all of these amounts you incurred, you are never reimbursed by your employers, then feel free to claim them as tax deductions. But most importantly, ensure you maintain receipts for all of this expenditure just to confirm that it is legitimate. The last neglected deduction is what I call the employment-related expenditures. So if you incurred any cost on behalf of your employer or your company and you are not reimbursed for that amount, feel free to also capture that as part of your deductions for tax purposes. So all you need to do to claim this deduction is to obtain the T2200 form from your employer and ensure that it clearly states the expenditures you have incurred and the amount that was reimbursed to you. Now with this form, you can easily claim your tax deduction as part of your tax filing purposes. Alright, that takes us to strategy number 5, which is tax credits. So just like I did for tax deductions, I'm going to be talking about the most neglected tax credits that people should be claiming today, which I've seen many people missing out on. So the first one I'll be talking about is the child care credits. So if you paid for child care just to enable you go to school, work, or run your business, or you even pay for overnight camps or summer day camps, then I want to tell you that you can actually claim them as part of your tax credit for the year. Secondly is the Canada Caregiver Credit. So there are many Canadians that support dependents or relatives who have disabilities, whether in or outside Canada. So this could be in form of food, accommodation, transportation, medical expenses, whatsoever. If you incur a couple of these costs, even if the individual is not in Canada, you might actually qualify for this tax credit. The third credit I'm going to be talking about is what I call the first-time home buyer's credit. So if you, your spouse, or your common law partner just acquired a qualifying home, you can actually claim as much as $5,000 as a first-time home buyer's credit. So for you to qualify for this $5,000 credit, you, your spouse, or your common law partner must not have lived in a home that you own in the year of purchasing that new home or 4 years preceding the year of purchasing that new home. So that's to say the previous 4 years before purchasing the new home and the year of purchasing that new home. The next overlooked credit is what I call the digital news subscription credit. Did you know that you could claim up to $500 from your digital subscription credits? If you have actually incurred cost on digital news subscription, then you can actually claim up to 15% of how much you incurred on that subscription. The next credit I'll be talking about is the tuition tax credit. If you actually attended a qualifying post-secondary institution, there's a high likelihood that you'll be qualifying for this tax credit. So the amount of tax credit you'll be getting is calculated by multiplying whatever amount of tuition you paid by the lowest tax bracket, which is currently 15%. So this tax credit can serve as a discount to your income tax bill, and of course you can carry it forward up to 10 years. However, you need to be at least 16 years before you can claim this credit. The last one I'll be talking about is the student loan interest. So the interest you pay on your eligible student loan can be used as a tax credit for you. So whatever interest you pay on an eligible student loan can be applied or claimed as tax credit up to 5 years, which means you can roll forward to 5 years. So those are all the tax credit which you need to check if you qualify for and take advantage of it. So this brings us to our sixth strategy, which is to split your income or pension with your spouse. So this strategy entails transferring funds from a higher income earning spouse to a lower income earning spouse just strictly for tax advantage. And this can be done through two major ways, which is spousal RRSP and pensions after retirement. So for the spousal RRSP, the higher income earner will contribute to the RRSP account of the lower income earner up to the person's contribution limit. However, it's important for the spouse that is receiving the funds to ensure that those funds sit in the RRSP account for at least 3 years. If funds are moved out of the account in less than 3 years, those funds will be taxed in the hands of the higher income earner. In the case of the pension, same thing applies except that the higher income earner can share up to 50% of their pension amount with the lower income earner. The seventh strategy is what I call hiring a family member. So when you hire and pay salary to a family member like your spouse or your children, you have successfully moved your business income to those with lower tax brackets in your home. Now this is simply because you can deduct those salaries that you have paid as business expenses. However, for this to effectively work for you, you must be able to prove that the family member actually did the work and the work was actually very important to your business to earn income and the salary that you paid was very reasonable. Also remember that payment does not always have to be in cash. It can also be in form of products of the business, but you must always maintain evidences of all kinds of payments which you have made. Number 8 strategy is for you to start a business. So if you start a home-based business, you have the advantage of deducting your home-based expenses as part of your business expenses. And of course, this results in lesser taxes for you. Expenses like your rent, your mortgage, your utilities, and so much more can be factored into your business expenses. However, for you to do this effectively, you must be able to calculate the percentage of your home square foot that you use for your business. And based on that, allocate the percentage of those expenses to the business. The ninth and very effective strategy is for you to file your taxes early. So when you file your taxes early, you avoid the risk of being surcharged penalties for late filing, and of course for individuals you need to hit the deadline of April 30th, and for self-employed people June 15 is your deadline. You must not exceed this, because if you do, you pay a penalty of 5% of the balance and 1% for every month of default. The 10th strategy I'm going to talk about is what I call the capital gains reserve. As you probably already know, if you make capital gains on a property that you sell, there's always going to be capital gains tax. However, you can claim a capital reserve when you choose not to receive the full payment for that property at once, but you prefer to spread it over a number of years. So this actually means that you get to report a portion of your capital gains on a yearly basis rather than the full amount in one single year. Now, when you do this, it's going to significantly save you a lot of taxes on an ongoing basis. Alright, I hope you take all these tactics and strategies into consideration when you're filing your taxes in 2024. Also, feel free to drop a comment regarding whatever you've been able to save by adopting this strategy when you're filing your taxes in 2024. Alright, thanks for taking the time to watch this video. See you at the next video and happy filing.